Wait, there he is. His hand went down. I want to thank Greg for sharing his knowledge with us today, and Nikolai and NBIM for hosting us today. And when I was offered the chance to discuss investment philosophy, I said, there's no way I'd rather spend my birthday. I'm extremely interested in investment philosophy. I think it has to undergird everything we do. My argument is that our behavior has to be well thought out and intentional. And so our methodology has to be as well. You'll hear that it's different, but at least we have thought it out, and it is intentional. It starts with a conscious decision as to what you want to accomplish. Now, this may sound easy. Well, we want to have more money rather than less. We want to have a higher return rather than less. But the starting question for any organization in investing should be, will we settle for average, or do we want to try to be above average? Now, that sounds like an easy one. But you have to recognize that in investing, it's extremely easy to be average. You can buy off-the-shelf products that will guarantee you that you'll do average. Or you can try to be above average, which is extremely difficult. And there is no surefire solution to how to get there. And if you try to be above average, it exposes you to the risk of being below average. The two are inseparable. So thoughtfully, consciously, intentionally, which is it for you and your organization? Next, I believe that an organization has to have a creed, a religion, the things it believes in, the things it doesn't believe in, the things it will do, the things it won't do because it doesn't trust them. And you have to stick to it. And again, it has to be conscious and intentional. Now, I wish the print was bigger so I could see it. I could probably see it if I do a little bit of this. But the truth is, we have to make decisions. What will be our intention? What do we believe in? Will we trust macro forecasting, or will we abstain from it? Will we, pardon me, how do you think about risk? Will you take a high-risk approach or a low-risk approach? Which is your route to success? It's not the same for everybody. Do you believe in the efficient market? This is extremely important. It's the most important concept I took away from my graduate education at the University of Chicago in the late 60s. Many people understand the concept. Very few people incorporate it and think about it in their daily lives. These are some of the things that we have to consider. So let's talk first about the concept of market efficiency. Now, the theory of market efficiency is that there are a lot of people out there, and they're all numerate, intelligent, highly motivated, objective, and rational. And they all want to accomplish the thing you do, which is to end up with more money than you started with. Given the scope of competition, how will you be the one who accomplishes the goal rather than them? Not easily thought out. Now, what we call the strong form of the efficient market hypothesis says that due to these circumstances, all information is immediately incorporated into the price of assets, to the extent that no one person can figure out which are the bargains and which are the overpricings. Now, the really strong form is actually a little different. It says that the prices of assets as a result of this intensive process are always right. You can't beat them, and so you can't beat the market. Now, I don't think that's right. I think the prices are not necessarily right. They're just the best that the consensus can do, and it's hard for any one person to be smarter than the consensus consistently. Two different things, but the bottom line on both is the same. You can't beat the market. So the question is, do you accept that? And that pushes you toward a passive approach, targeting average performance, low cost, low risk, highly likely to succeed to accomplish your objective, which is being average? Or will you try to be above average in the face of the very strong competition that exists? Will you endure the costs? Will your pursuit of being above average permit you to be exposed to the risk of being below average? And will you engage in this pursuit of superior performance, which is not that likely to succeed? The first thing I learned at University of Chicago was that on average, most people do average before fees and below average after fees. And the thought at the time, 1968, was, well, why don't they just buy one share of every stock in the S&P 500? There was no discussion of index funds or indexation. These had yet to be invented, basically by Jack Bogle at Vanguard in '74. But you can see where the concept went. And today, most mutual fund equity capital is managed passively or through indexation. So it was not irrelevant, it was persuasive. Will you try to be active and be above average, or passive and be average? Do you have the people in hand who can accomplish it, or the ability to find those people and hire them as outside managers? What happens at the moment when average performance is X, and a few people publish performance which is much better, and your bosses say, "Who's the idiot who signed on for average performance?" So these are questions, but it's very fundamental to the selection of an investment approach to understand and reflect the concept of market efficiency. The next is knowing where returns come from. You can have an average portfolio and do average, or you can say, well, this is a company that I think is going to deliver positive news which is unanticipated by others, positive surprises. And if you can figure out which ones will deliver positive surprises, you can overweight your portfolio toward those. And then when the news comes out and it conforms with your view, everybody else says, oh, I wish I had more. They go out and buy it. That forces the price up. You are an above average performer. So that's the root. How regularly can it be accomplished? That's the question. If you think different from others, you have what we call a deviant perception. How often will you be right, as opposed to the consensus being right and you being wrong? This is at the heart of things. Again, you're up against intelligent competition. And when I started my career at a large and bureaucratic institution in the equity department, people would ask, well, what do you think you can make for us? And the answer was 12%. Well, how do you arrive at 12? Well, the S&P 500 does 10 on average, has done at that point in time for 60 years. So if you can get 10 without any effort, you should be able to get, well, let's say 20% better with a little elbow grease. In other words, 12. But what if all the elbow grease in the world doesn't accomplish anything because the market's efficient and you can't get an advantage? Then it's not only a waste of effort, but it's a waste of management fees. And of course, management fees are the only certainty in the investing world. Now, another important question is, will you bet on macro forecasts? Everybody makes macro forecasts, and yet I don't believe that they are of any use. That's a mild exaggeration, but not so great. The truth of the matter is that most of the time, things continue as they are. So a forecast of extrapolation is correct most of the time. And most people share that view. Most people expect extrapolation. Extrapolation of the recent trends, the long-term trends, is incorporated in security prices. So when the extrapolation turns out to be correct, it's not a profitable expectation because everybody else had it as well. It was in the price you paid. The forecasts that are very profitable are the ones that call for radical deviation from trend, radical deviation from extrapolation. These are very significant when you make them and they're right. The trouble is they're not right very often because most of the time things are extrapolated. And so we have forecasts of extrapolation, which are usually correct but not profitable, and forecasts of deviation from trend, which are potentially very profitable but not often correct. I take that analysis to mean macro forecasting doesn't work. And when we started Oaktree 29 years ago this month, we sat down and we wrote out the things we had been doing because we had the benefit of having worked together for 9 years already on average. And we have a very simple investment philosophy of 6 points, which governs everything we do. And number 5 says that our actions are not driven by macro forecasts. We are bottom-up investors selecting individual companies, not top-down selecting markets and countries. So that's a difference. We think we can get an advantage. By the way, where does outperforming come from? In short, it comes from having a knowledge advantage. And you have to know something better than most other people to outperform. Just trying is not going to help you if you don't know something they don't know. So we think we can get a knowledge advantage in studying the micro companies, industries, and securities, not the macro countries, markets, and rates, for example. So, we bar that from our approach. One of my heroes is John Kenneth Galbraith, who said we have 2 kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I've known for decades that I don't know. So I think we have an advantage in that. And then that kind of sounds like forecasting, macro forecasting is unavailing, but the truth is that it can be worse than neutral in its effect. It can be damaging in its effect. And I quote the American humorist and novelist Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." No sentence that starts with, "I don't know, but," or "I could be wrong, but," ever got anybody into trouble. The ones that get you into trouble are the ones that say, "I'm sure that's such and such," because if you believe something strongly and you bet on it heavily and you're wrong, that's how you get into big trouble. So will you bet on macro forecasting? This, in my opinion, is a critical and overarching decision. I wrote a memo a year and a half ago, I think it was October of 22, entitled "The Illusion of Knowledge." And it's basically a rant against macro forecasting, starting with a famous quote in each section. I think it's extremely important to decide, will you or won't you start from a top-down macro forecast? And most people do. Many people know they don't work. They do it anyway. And I quote somebody in there as saying that most people couldn't get out of bed in the morning if they admitted how uncertain the future is. And so I believe that macro forecasting, in my view, often takes the form of, can I say, organized religion. It gives something to believe in to dispel the great uncertainty present in the world they live in. I believe that very few people have the ability to do it in a superior fashion. Now, the next question is, how will you and your organization think about risk? What is risk? In all the formula mathematical work in the investment business, people use variability of results as the measure of risk. I don't think that's the real risk. I think the real risk is the risk of bad outcomes. The trouble with my form of risk is it's not measurable. You can't measure what the probability of bad outcomes is in the future. You can't even measure what the probability of bad outcomes was in the past. You can only measure what happened, which is a subset of what could have happened. On the last slide, I had a quote from Elroy Dimpson, who was a professor at the London Business School. He said, "Risk means more things can happen than will happen." The conventional view of risk is shown in this graphic here. You have return on the vertical axis, risk on the horizontal axis, and a line that slopes up and to the right. And mathematicians call this positive correlation. If one goes up, the other goes up. Most practitioners take this to mean that riskier assets have higher returns. There's something wrong with that formulation. If riskier assets could be counted on to have higher returns, by definition, they wouldn't be risky. So the way I look at it is more like this. I take these little bell-shaped curves, I superimpose them on the same line. It's the same underlying line. But now, as you move from left to right, not only does the expected return increase, but the range of possible outcomes gets wider, and the bad outcomes become worse. That, I think, is risk. That is what people should concern themselves, not the possibility that their return streams will be lumpy. Buffett said, "I'd rather have a lumpy 15 than a smooth 12." And I think that makes a lot of sense. So I think the most important job of the professional investor is to manage risk. And, Greg in his talk said, "What do you believe in?" And I think that's very important. And you could hear in his presentation how much of the time they devote to assessing, managing, and balancing risk. And we have to do the same thing. We have to assess it and manage it, even though we do it from a bottom-up micro level, not top-down. But I think that you have to constantly work with risk, but you have to never assume, as Mark Twain cautions, that you know it for certain. We never know what is going to happen, and the events show that in the world. We never know how the market will react to what happens in the short run. And if you want proof of those two statements, take a look at the US presidential election of 2016. Everybody was confident of two things. Hillary would win, 80% probable, and if by some quirk of fate Trump won, the market would collapse. Instead, Trump won, and the market went up for 14 months, 30%. So we don't know, and we don't ever assume that our intellectual process permits us to get the risk under control. And then, lastly, you have to accept that it's very hard to have both superior returns and low risk, a high degree of safety. Going for superior returns means taking some risk. You have to either bet on riskier companies, riskier propositions, things that are considered unpopular and out of favor, and things that, if you're wrong, will result in your being below average. And you have to figure out for yourself what your approach is. I'm a tennis player, and last summer, while watching the tennis tournaments, especially Wimbledon, I wrote a memo entitled, "Fewer Losers or More Winners." You have to have an approach, in my opinion, which will organize your pursuit of superior returns, and there's really two ways to do it. You have to either have more of the things that do above average, or less of the things that do below average. There is no alternative. Of course, you could do both. I think for most people, given their mentality, one or the other is more likely. The conservative person can, in theory, have fewer of the things that do poorly. The skilled, aggressive person can, in theory, have more of the things that do well. Each person has to understand their own mentality, what's possible for them, and thus what their pursuit will be. And these things, in my opinion, taken together, are examples of the elements that combine to produce an investment philosophy. And we've done it at Oaktree. Everybody knows where we stand. Everybody is pulling together in the same direction. Thank you very much.